We find ourselves in August of 2007 with extremely volatile markets, with a credit crunch in the fixed income markets. March of 2007 saw the first sort of suggestions that there were problems in the subprime mortgage sector of the U.S. May of 2007 we started to see credit spreads move out, really a harbinger of things to come in terms of the way the markets were looking at repricing risk. In July of 2007 saw the peak for the year to this point of the equity markets, and there's been a fairly significant sell-off since then, with really a volatility that we haven't seen over the course of the last 4 or 5 years, where there's been a pretty consistent run-up in equity markets. The credit crunch that we're experiencing in the markets is simply an issue of people that have borrowed money not being able to continue to borrow it. You think of a person that has a mortgage on their house that's expiring at the end of the month. They go to their bank and they try to refinance or renegotiate the terms of that mortgage. The bank says no. What options do people have? Well, they simply have to sell their house or find another source of finance. And when there's no other source of finance, that's very much like what we're finding with this credit crunch. Those that have borrowed money simply cannot find ways to continue to fund that borrowing and that leverage, and that leads to liquidations of other assets. If we were to fast forward to July, we saw some very, very tangible signs of issues in the subprime mortgage market. There were a number of defaults that were starting to come to the fore. There were bankruptcies of mortgage companies in the U.S. becoming apparent and physically being filed. Depressed earnings from U.S. home builders and anybody with excessive exposure to the U.S. housing market. And it started to show up in terms of the financial world with a couple of hedge funds run by Bear Stearns and then a couple run by Banque Nationale, BNP in Paris, one of the largest French banks, that had excessive exposure to the U.S. subprime mortgage market and were in default or were in serious financial difficulties because of liquidity issues. That has come at a time where there's essentially a buyer's strike in the credit markets. So what you're seeing is investors that either have cash or and are sitting on the sidelines with it, or more problematically, ones that have been invested in different types of corporate paper, having their money mature and no longer having the appetite to reinvest in other fixed income products. So it becomes a fairly toxic combination. You've got hedge funds that are running into liquidity issues because of defaults and because of problems with pricing the corporate paper that they own. You run into buyers that aren't willing to reinvest money that matures. And what happens when funds are in a liquidity situation or a liquidity crunch, they need to raise cash. And in July, we finally started to see that sort through and play into the equity markets for really the first time. I think the equity markets globally, most people would say, peaked on July 19th. And since then, we've seen liquidations from different financial intermediaries, different financial players. And more importantly, we've seen incredible volatility in really all global equity markets, and most have dropped by at least 10% over that period of time. I think it's important for investors in periods like this, where there's pretty extreme market volatility, to be able to capitalize on opportunities that are presented by that volatility. And if you're able to buy good companies at discounted prices as a result of market forces that really have no impact on the long-term value of that security, the investor will be better off for it in the long run.